So if you spent the last 2 weeks watching the tape, you'd think the world was ending. A Middle East war spiking oil, semiconductors down almost 8%, the Magnificent Seven off 5.5%. And yet, step back, and here we are, mostly fine.
Right. And that's the whole story of this week in review. It felt scary, but almost all of it was noise and plumbing, not a thesis breaking. The genuinely important signal is much quieter. A Federal Reserve that turned hawkish, a bond market that mostly shrugged, and 3 data prints next week that actually decide the path into July.
So today, we'll separate the noise from the signal. Walk the scary headlines that didn't matter, the mechanical move that confused everyone, the Fed versus bond standoff, and then the short checklist that actually does matter for the week ahead. Quick disclaimer first.
First, a quick and honest word. Everything you're about to hear is really just the two of us thinking out loud. Personal market commentary, made for learning and for fun. It isn't investment advice, and it isn't a recommendation.
And when we talk about a specific company, it's only ever to make a bigger idea click, never a nudge to buy or to sell. So take it as a starting point for your own curiosity. Do your own research and make the call that's right for you.
Fast and simple. This is for education and entertainment, not investment advice. Every company we mention is a public example to make a point, never a recommendation. We don't give buy or sell calls, and we don't do price targets. Please always do your own research.
Start with the scariest headline, Iran. And the lesson of the fortnight was simple. Price is the answer, not the headlines. Oil round-tripped all the way back to where it started. Brent slid back under $72, basically a pre-war level.
And the shipping data was even louder than the futures. Supertanker rates fell 44% in just 4 days. Roughly 3/4 of the disrupted exports were already flowing again. And the U.S. set a 60-day sanctions waiver, described as the biggest easing in decades. The market had quietly moved on while the headlines were still shouting.
The honest caveat, it lags at the pump. U.S. gasoline was still around 30% above pre-war levels. But the through line holds. The conflict that dominated 2 weeks of headlines barely dented the fundamentals. Scary, but not a thesis changer.
And you saw the same pattern in the cross currents. Asian tech and Taiwan took heavy foreign selling on the war fear, the kind of de-risking that whips out fast and then drifts back. It's a recurring lesson. When the price action fades faster than the headlines do, the fear was the trade, not a change in the underlying fundamentals. Headlines are loud. The tape is honest. Now the part that genuinely confused people. Everything moved. Small caps revived. The equal weight index beat the mega caps. 8 of 11 sectors rose. That looks like a big rotation, but most of it was the calendar.
2 huge flow events landed at the same time. The Russell reconstitution, the single biggest volume day of the year, around $12 trillion benchmarked to those indexes, forced a wave of small cap buying. And on top of that, quarter and fiscal year-end rebalancing, an estimated $55 to $165 billion, did the classic move, trim the winners, rotate into the laggards.
So when you see small caps and values suddenly outperforming on a wild tape, the honest read isn't the market re-rated. It's the plumbing ran. And plumbing flows tend to fade or partly reverse once the recon and rebalance clear in the first few days of July.
And there's a tell that confirms it was mechanical rather than conviction. It was indiscriminate. In a real, theme-driven rotation, money moves toward a story, a sector, an idea. Here, the laggards that bounced didn't share a story. They shared a characteristic. They had simply underperformed, so the rebalance bought them. That's the fingerprint of a rebalance, not a rethink. And the texture inside that move is worth a closer look because it's the season's whole signature. Semiconductors fell almost 8% on the fortnight, while software jumped nearly 10%. The Magnificent Seven, as a group, dropped about 5.5%. Money rotated out of the crowded winners and into almost everything else.
And valuations frame why that's not a panic. Forward price to earnings on the broad index sits around 20. The NASDAQ 100 in the low 20s, the semis around 25, off a higher peak. Those are full, but they're not the stretched, euphoric multiples you see at a top. So, a rotation and a breather. not a fundamental derating.
And the sentiment backdrop fits that read. The popular fear gauges actually swung toward the fearful end, even as the index sat near its highs, a divergence that often shows up mid-rotation, when the averages hold, but the leadership underneath is quietly changing hands. Crowded trades getting uncrowded rarely feels calm from the inside, even when the index barely moves.
And put a number on it. The semis fell almost 8%, while software rose nearly 10%. An 18-point spread between two slices of tech in the very same 2 weeks. When the pieces scatter that far apart while the index sits still, you're not really looking at one market. You're looking at a dozen smaller ones, each trading its own story. Underneath all of it, the real signal, the Federal Reserve. Chair Warsh held rates steady but quietly dropped the easing bias. 9 of 18 officials now pencil in at least one more hike, and the median dot for end of year drifted up. The odds of a September hike are roughly a coin flip, so it's a live risk, and it is not fully priced in.
And that's the part that could genuinely matter, far more than any oil headline. A market that spent a year expecting cuts is being asked to consider the other direction. So the question becomes, does the rest of the market actually believe it?
And it's worth being precise here. A hawkish hold isn't a hike. The Fed simply took its foot off the cuts are coming pedal and said, in effect, we'll let the data decide. That's a meaningfully different posture from actively tightening into a slowdown. And it's exactly why the bond market's reaction, not the press conference tone, is the tell worth reading. And here's the tell. The bond market mostly disagreed, politely. The 2-year yield sits near 4.1, the 10-year near 4.4, only modestly above the funds rate. And notably, the 10-year actually fell after the meeting.
Which is the bond market doing the Fed's work for it. Higher expected short rates are pulling long rates down because investors read hawkishness as slower growth later, not runaway inflation. Translation: bonds are pricing one hike at most, higher for longer, but no crisis. No deep inversion, no recession panic. So the hawkish turn is a real risk, but it's largely absorbed. And the actual switch isn't the Fed's tone, it's the incoming data. Which brings us to the gate, and it's a holiday-shortened week with the market closed Friday. Tuesday brings job openings and consumer confidence. Wednesday, the manufacturing index expected around 53.6. And Thursday, the June jobs report, consensus near 115,000, unemployment about 4.3.
And the two paths are clean. Goldilocks, cooling but not collapsing. The factory index holding above 50, soft wages. And the September hike fear keeps fading. Run hot. A wage or factory price spike, and that hike snaps right back onto the table. Same prints, opposite trades. That's the whole week in one sentence.
And it helps to know what each print really whispers. Tuesday's job openings and confidence are the early read on whether hiring is cooling gently or cracking. Wednesday's factory index carries a quiet inflation signal inside its prices paid component. And Thursday's payrolls are the headline. But on a holiday-thinned week, with many desks half-staffed, any surprise can shove the tape around more than it really should. Thin liquidity exaggerates everything.
And why care about all this right now? Seasonality. July is historically the strongest month of the year, up around 2.8% on average, and green 11 years in a row. Plus, the Magnificent 7 report roughly July 22nd to 30th. So early July is the runway into that earnings stretch.
So the sequence to watch is the recon and rebalance flows clear, the data cooperates, and a pre-earnings window can open. But balance it honestly. Multiples are full, and you can always get the classic sell the news once the reports actually land. It's a setup that needs cooperation. It is not a sure thing.
And history is a tendency, not a guarantee. 11 green Julys in a row is a striking streak. But streaks, by definition, end, and it always works, is usually the last thing you hear before it doesn't. So the honest framing is, the seasonal wind is at the market's back, if the data lets it blow. We're describing a setup and its conditions, not promising the outcome. Step back to the bigger picture, and the season's pattern is sharp. The market rewards the shovel sellers and doubts the shovel buyers. The Magnificent Seven's weakness wasn't bad earnings. It was the question, will they ever recoup this capex? Meanwhile, the suppliers of scarce inputs keep getting paid.
And the live macro story underneath is tech inflation. Memory prices have roughly quadrupled in 2 years. That cost is rippling into phones and consoles. It's a real, durable story. Compute and memory are genuinely scarce, and the spending behind them isn't expected to stop before the end of the decade. That's the opposite of a bubble popping. It's a bottleneck biting.
And that's the cleanest way to hold the whole picture. The spenders, the big platforms pouring money into the AI build, get doubted on the question, will this ever pay off? Meanwhile, the suppliers of the scarce inputs keep their pricing power and keep getting paid. The framework doesn't need to guess which AI app or which chatbot wins. It just keeps watching whether the inputs stay genuinely hard to get.
And there's a nuance we want to frame carefully, because it's easy to get wrong. The cheaper open source and China models that everyone's talking about, they are not a sign that AI demand is collapsing or that prices are falling apart.
Exactly. It's diversification and optimization, not demand death. Some of those open models are now genuinely good enough for most everyday tasks at a fraction of the cost. So the tokens get served in more places, more cheaply. But here's the twist. Cheaper per token tends to mean more tokens overall. And more tokens still means more memory and more power. The scarce inputs stay scarce. That's the framework holding.
And it's counterintuitive enough that it's worth saying plainly. A price war in AI models can actually be bullish for the picks and shovels. Cheaper intelligence just gets used more. The way cheaper electricity never shrank the power industry, it grew it. So the thing to watch isn't the price per token, it's the total tokens, and the memory and the megawatts sitting underneath them.
One more quiet cross-check on the macro plumbing. As the dollar surged this fortnight, its biggest monthly gain in about a year, with the yen at a 40-year low, you saw the speculative and debasement trades soften together. Gold dipped below its longer-term average, and Bitcoin is actually down for a second year.
And that combination is telling. When equities make records while gold and crypto are both soft, it suggests liquidity isn't simply flooding everywhere. The money is being selective, which fits everything else we've said. A narrow, rotational tape, not a broad. Everything rips melt up. Worth keeping in the back of your mind.
And it ties a neat bow on the fortnight. A strong dollar, selective liquidity, a rotational tape, and a hawkish but largely absorbed Fed. Notice that not one of those is a thesis actually breaking. All of it is a market digesting, chewing through calendar flows and a policy shift, waiting, exactly like we are, for the data to tip its hand. So let's put both sides on the table fairly. The bull case. The last 2 weeks were a mechanical washout. The Fed is at most one hike away, and there's a seasonal earnings runway into a historically strong month. The bear case, a 50+% hike risk that isn't fully priced, full valuations, and real, unresolved doubt about whether the AI capex pays off.
And we're not going to call it for you. That's not what this show does. The honest move is to hold both and let the evidence break the tie.
And honestly, that's the posture of this whole show. We're not bulls or bears by temperament. We hold a set of theses. We write down in advance what would prove each one wrong, and then we let weeks like this one nudge the needle a little, one way or the other. This particular week barely moved it. Noise and plumbing rarely do.
So that's the week. A scare that mostly didn't matter, a move that was mostly plumbing, a Fed that turned hawkish while bonds shrugged, and a data week that actually decides the next step. The checklist is short. Watch the 3 prints. Soft, and the hike fear ebbs, and the July window opens. Hot, and it's back on the table.
We don't predict. We maintain the theses and test them as the evidence lands. Thanks for spending part of your week with us. If this helped, follow the working thesis and tell us in the comments, are you reading the last 2 weeks as noise or as a turn? See you in 7 days. And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.